Record computer side. Okay, we are live. Portfolio Builder is now outperforming the S&P 500 by 2,226% since inception. And in 2023, our high-risk portfolio is beating the S&P 500 by 196%. Buy these stocks now to get rich ahead of the 2024 market cycle. High-risk portfolio allocation. Okay, so we've been making most of our money this year on FNGU. It is by far the best performing stock, ETF in the market. And that's because the tech companies led with AI productivity growth have really been bringing in all the profits. In fact, there's only a handful of stocks that are up this year, making the entire S&P 500 go up, and you get them leveraged times 3 with FNGU. Let's take a look at the breakdown. Per unit of investment, all members follow the exact same formula. With $3,888 at work, you have 42 shares of UVXY, your crash insurance. You've got 98 shares of TMF. That's 3 times the TLT, or the long end of the bond market. We're betting inflation is going to fall, that growth is going to slow down, that perhaps earnings are going to get squished, and that we could enter a recession within the next 12 to 24 months. And that's what's going to make TMF double, triple, quadruple. We're still a big believer in it. Both the high-risk portfolio, we were betting on no recession anytime soon by being long Coinbase with 17 shares, FNGU, 3 times the giant tech giants, 14 shares, and then we're hedging against oil lightly with NRGU. That's the big oil and gas companies, leverage times 3. So don't see us really changing anything in the very short term. Once we get the debt ceiling lifted and see the terms of that, that could affect the bond market and potentially the valuation of tech stocks. So we'll be keeping a close eye on that. However, if the Republicans get their way and force a lot of spending cuts up to 15%, that could drive yields lower as the Treasury refills the coffins and drive the tech rally even further. Now, again, once we see too much falling inflation and the Fed gets too dovish, we're going to expect inflation to come back with NRGU. I think we're going to be doubling down on NRGU later in the year, not this summer. So we'll keep you posted on that. Most likely no changes in this portfolio. Let the profits keep running before we do a rebalance. Most likely till we get the next Fed, the Fed minutes in June. Here's the returns. So we're up to a 24.69% return in 2023, up 5.22% in May. Now we have a second program called the Safe Growth Portfolio, and it is loaded up in bonds. The bonds have been underperforming this year because inflation and the labor markets remain strong. The inflation's not falling nearly as fast as we anticipated, and the labor markets are not deteriorating really whatsoever. So the recession, growth slowdown, and earnings slashes just aren't happening yet. Now, I do believe within 24 months, this absolutely will occur, and that we're going to see the ticker TMF double, triple, maybe even quadruple. So until we start to get some big moves on that, I don't see the safe growth getting out of this. TMF is in nearly a 2-year bear market that bottomed out last year and has been trading sideways this year. We still think this can deliver the safest return on capital possible over the next 2 years. And that's why we have such a large position in our safe growth portfolio. Furthermore, when the inflation does come down and interest rates fall, typically we get emerging markets outperforming the US markets. That's why we're leveraged times 3 with EDC. And again, China's stocks and Asia stocks have been beaten down much worse than US stocks over the last year and a half. So we're looking at value plays here. Now we're about double the hedge with NRGU in safe growth. So we're very big on bonds in case there's a slowdown. If inflation resurges, we've got NRGU, and then we're playing some growth assets with EDC and GBTC. So GBTC has delivered the majority of returns for this portfolio this year. And even though it's underperforming so far compared to high risk, over the course of 24 months, I do think this is going to have an absolutely stunning return with a little patience. We know interest rates must come down for governments globally to continue running massive deficits. Looks like the US is going to run a $1.6 to $2 trillion deficit this year. and they can't finance it at these extreme interest rates. In fact, Janet Yellen's announced she's going to do treasury bond buybacks to lead into the next, we can't say the word, we might get banned, but you know it's happening in 2024 in November. So there's going to be a lot of manipulation of the bond markets to fund this massive deficit they're running, this huge spending plan, and to get markets up for the November event. Again, we can't say it out loud or we'll get banned. So I'm not seeing us change much in this portfolio in the near term as well. Highly confident over the stretch of 2 years, we're going to make massive, at least double or triple the returns of this entire portfolio with very few changes. High conviction in every single play in this portfolio going up. With that said, it's having a 2-month drawdown and is now negative 1.8% for the year. It came off strong in January with interest rates falling and that bond play really playing off with a 12% gain. February, all the data came in hot from January. So the bond market reversed course and gave back that whole profit. March, we had a nice gain, but we've given that back in the last 2 months. A little patience, and I do believe this is going to be an outstanding return with very few changes. And we're playing value plays that are basically been in very long-term bear markets. We think they're in the bottoming process and about to outperform everything else. If you want to learn more about our products, call Dean at 505-322-7515. Okay, so let's look at the CPI data that came in. It fell from 5 consensus to 4.9. And so we're starting to see everything start to really move down here. Perhaps the most important one will be shelter in place falling over the next year, which is not in the super core. But again, this super core inflation print shows just about everything squishing lower month over month. Now, this is a predictive model from Steno Research looking at NFIB price plans. So company price plans, you can see companies are planning to reduce rising prices, essentially. So they're not going to rise prices as much. And this has been highly predictive of CPI. So this is all our leading indicators, including commodities, are pointing to falling inflation for the next year, which means lower interest rates and higher valuations in equities, so long as you don't get a collapse in credit, bankruptcies, or something causing a loss of capital due to the slowdown. Okay, so the core CPI and the main CPI did both fall by 0.1, but this is way above the 2% target. We still believe that the Fed will pause in June, but we're going to get one more CPI print before the June decision. So that'll be an interesting 2 days coming up next month. But again, you can see the trend is consistently falling inflation. It's falling slowly but surely, and that's what we've been predicting and positioned for. Now, in this breakdown, we can see a lot of the crash in the CPI was from energy. Perhaps there's some manipulation in the oil market last week to crash oil by about 10%. And this is the primary driver of the deflation in this weekly update. But however, shelter still running hot. We know is about to fall for the next year. So we're highly confident that this is going to continue to trend downwards for the next year approximately. Meanwhile, if we look at real wages, so we're looking at the inflation rate relative to labor increases, we can see, even though people are making more and more money, it's still negative against the rising cost of goods and services. So this is good to predict that the demand factor on the economy is going to slow down. In fact, Biden's entire presidency, there's been completely a reduction of spending power. Stanley Druckenmiller had an interesting speech saying that he's very concerned about basically trying to pay for Social Security for the next 30 years. That's going to turn into about $70 trillion of spending that's not accounted for, and it's going to slowly grow to a massive portion of the GDP. So either there will be massive reforms to when you can get your Social Security, like they did in France, or there's going to be a lot of money printing. So my bet is governments are going to print money and the voters are going to continue to vote to get free stuff, which means we want to be long things like digital currencies aggressively for the coming decades. And here's another chart showing the same thing. Medicare, Medicaid, chip Social Security in the next several decades could grow to a massive percentage of the entire US GDP. Janet Yellen says US Treasuries to launch first buyback program since 2000. Okay, so the goal of this is to borrow at a lower interest rate and drive down the front end of the market. We've got an inverted yield curve, which you can see here. And so essentially what she's planning to do is borrow a lot of long-term debt and buy up the short-term debt that's at an extremely high interest rate. This will essentially reduce the interest payments for the US government and probably drive the entire yield curve lower, which would make stocks go up. Because remember, stocks compete against bonds. We're looking at the cash flow of a company compared to the cash flow of a bond. If the bond's cash flow is reduced, then the relative value of these companies goes up. So this is a gimmick for the November 2024 event, which again, we think will be extremely bullish. So this year they need to get the inflation crashing to get the bond market on their side, and then they can roll out this this type of quantitative easing to really drive both bonds and stocks higher towards November. So exciting times to come. This is the prediction for the deficit coming in at 1.6 trillion. To start the year, they're estimating 1.1. Excuse me, they're expecting 1.6. But they've already spent 1.1 in the first 6 months of the fiscal year, which begins November of last year. So now they're supposed to run the rest of the budget for $500 billion. Unlikely. I think they're going to get closer to a $2 trillion deficit this year. And again, these interest rates, it's just not plausible to last for a long time. So there's going to be a lot of effort to get these interest rates down. Now, here's an extrapolation of debt for the US, just to give you an idea of why stocks and digital currencies go up in value over time. It's due to the growth of debt. The US has been averaging a 6.5% year-over-year growth in its debt over the last decade. If you just extrapolate that, by 2033, we'll grow from a $32 trillion deficit after 100 years plus of growing debt. We're going to double it in the next decade. In fact, we're set to basically almost double the deficit every decade from here. And it's just mind-boggling. We go from 60 trillion to 113 trillion in 2043 to 214 trillion in 2053. So just mind-boggling to watch the exponential growth. Now, the yield curve is the most inverted for the last 40 years. And this typically happens when inflation gets hot and the Federal Reserve jacks up interest rates, which makes the front end of the bond market have higher interest rates than the longer duration assets. Typically, this means a recession is coming within 12 to 24 months, but the period leading up to it is oftentimes extremely bullish the second the Fed pauses. And so that's where we're at, that bullish moment where they're about to pause. Here's a little chart and saying, when do digital currencies bull runs start? And it's just looking at election cycles. Leading into the 2012 election cycle, a massive melt up. The year before, it slowly ran up, and then the year of it ran up massively all the way till the end of the year. In 2016, it made it all the way through April till you got a pullback, and same pattern. And in 2020, you had a massive melt up all the way till November. And again, in 2024, are we getting ready to see the same pattern develop? I think so. And we got the bond market on our side. Now, we got to be worried about a massive credit contraction due to bank failures. But when we compare the failures of 2008 to today, adjusted for the M2 money supply, we can see it's nowhere near the same magnitude. And we don't have bad mortgage products that are going bankrupt right now. We just have a bunch of banks that bought up treasuries because the Fed said they're never going to raise interest rates. Inflation was transitory. And now they've seen that the inflation is not transitory and the Fed has jacked up interest rates. So this is causing money to flee from small banks to larger banks. So we don't see this being a repeat of 2008 right now. Okay, this is a look at payrolls. We've had 28 weeks of positive expanding months in non-farm payrolls. The record was 100. We've seen 3 times it hit 48.4 to 48. So we'll see how long this strong economy can last. But we're not getting worried about a recession until they start printing negative. Now, even though we are having strong labor, the withheld employment taxes has been falling to flat, which means we're not seeing wage growth as much. So even though people are getting jobs, their income's not rising as fast as it had been since really 2019. So this is good for predicting that Goldilocks situation where people have money, but not too much money. The demand's not going to fall off a cliff, but it's going to stay strong. You can see here federal funds rates back to the same level they peaked at in 2006. And then it took about 2 years before it created a real estate crash that crashed the whole financial system. So again, this is a scary interest rate, but likely a very good time to go long because they're going to probably pause at the June 14th FOMC update. Real rates turn positive for the first time since 2019. Typically, that's when they pause. Let's take a look at some charts. So the 2-year has been very predictive of where the federal funds rate is going to end up. And so this is predicting that they're going to have to start cutting at some point back down towards 4, currently at the 5 to 5.25 range. Here's treasuries. Again, this is a play we think will hit at least 24, maybe 32 over the next 2 to 3 years. And again, it's just been trading flat this year. This is the TLT times 3. DXY has been in a sideways motion. I don't think the Treasury wants the dollar to fall in value till inflation is very cooled off. And so far it's not. So we've seen this trading in a range. A lot of the assets we're long are going to skyrocket when DXY falls towards 90, which I think could happen by 2025 as inflation falls and interest rates fall. Here's a look at the yield curve. You can see the highest interest rates on the 3-month at 5.26, the top of the federal funds rate. But after that, the market's predicting that interest rates need to fall, that inflation is coming down. And you can see the 30-year is trading at 3.8, and that's what we call an inverted yield curve. So as this is pushed flat, this could be a very bullish moment for markets. And again, that's expected to happen next year with Janet Yellen's Operation Twist is what they called it last time. F&G has been our biggest moneymaker by far, up 164% year to date, and it could go much, much higher. We're still trading a lot of these tech giants at 15 to 20% discounts from recent tops. Coinbase, we believe, is the best bet for digital currencies currently until we get better outlook on the Grayscale Trust, and it's up 85% this year. It's been up a little more. It's not leveraged, has zero chance of going bankrupt. It does have a Wells notice from the SEC, which we're following closely, but we think that likely they're going to win that case. GBTC is up 96%, the best performer for our safe growth portfolio. And we bought that because it was trading at a 30% discount relative to the assets that the Grayscale Trust has. And it has closed a lot of that gap this year. So that's been a good winner for the safe growth portfolio. Emerging markets started off with a bang and has been a dud since then. And that's because the inflations came back. The bond market has stayed flat. When interest rates fall, DXY falls, and CPI is really falling, we're going to see China print money like crazy because they'll be able to get away with it because the dollar is not going to be so strong. And that's when we think EDC is going to shoot back up and probably outperform the US markets in this cycle. Again, that's in the safe growth portfolio. Here we can see oil down 7% year to date. The big China reopening has not impacted oil or copper at all. And so this is really a whimper effect so far. Perhaps China's waiting to stimulate the consumer side of their economy once it's more clear that US inflation is falling and they won't destroy their currency if they start to print money while the US is tightening. And again, NRGU down 25% this year. This is our inflation hedge. I do think we need to double down on it, but probably not towards the end of the year. It looks like the credit cycle from China, and when they're going to really push money through it, it's going to be around the end of the year to early next year. So that's likely we're going to see a resurgence of inflation. Okay, so that's our update for today. Call Dean at 505-322-7515 to learn more. Here's a few disclaimers, but I will go ahead and take questions now. John's saying, should we make any? Well, the high risk portfolio is making those short, those riskier moves that have done better this year. And the only one that's really made a lot of money this year is FNGU. So we do recommend that. Of course, you have some of your money in the high risk portfolio. The safe growth strategy is designed to play the market safely. And so we're looking at the best value plays in the market. And yeah, I do think you're going to see some massive returns this year and next year in TMF. So no, I don't see anything worth changing at this point. Otherwise, I would be issuing a alert. Okay, very good. So don't forget, we have Rebel Dividends webinar and dividend next Monday. If you're not in that, call Dean. We are doing extremely well with that, with a weekly dividend, only available to paid members. We'll do another portfolio builder update next week. Not a lot of important data between this week and next. We're really going to be waiting for the June CPI will be the most important new data print. We're going to need it to fall below 4.9. People asking about BOIL. No, I don't see a good reason to go long BOIL. Just massive transformation of how people are using energy and massive oversupply of natural gas. Terry says, your thoughts on Texas and other offering on gold depositories? Yeah, gold's been doing really well. Central banks are gobbling it up. But I would rather have GBTC. Yeah, I was saying, should we buy more FNG? Well, I'd follow the trading plan as always. So if you want to allocate more capital to high risk, you certainly can. That'd be the way to do it. But follow use the calculator. So you punch in how much money you want to invest, and then it'll tell you how many shares to purchase based on the ratio. Yeah, so I think now's a good time to be patient. We need to get through the debt ceiling. We need to see how the budget's adjusted. Likely the Democrats are going to have to reduce their budget back to small, less spending. And this should be very good for markets because mainly they've been spending a little too much money, causing this inflation, which is forcing the Fed to hike rates. So I think a little less spending will actually be very, very bullish for all asset classes. And I do think they're not, we're heading into a vote in November of next year. And if they blow out the whole global economy by failing to pass the House's debt ceiling, then they're going to have zero chance. Everybody's going to blame it on them. Okay, very good, guys. Well, thank you so much for your time. If you have any questions, email us at support@portfoliobuilder.io. And again, I think both portfolios are set to make a lot of money with very few changes. One is playing value plays that I have extreme confidence in, but we may need to be a little more patient with. That's the safe growth. The high risk is looking at a much shorter time frame, which is much harder to time, and trying to make the most money possible with the willingness to take a lot of risk. And luckily, it's been doing extraordinarily well this year. So thank you guys so much, and we will be back next week. And again, if you want to get into Rebel Dividends, call Dean at 505-322-7515. It's only available to paid members due to the law. We have to have a pre-established relationship with you. So another good reason to join the program if you're not quite yet a paid member. So thank you guys so much, and we'll see you back next week.